In an effort to help with inflation, the Federal Reserve is making what some consider a bold move. The Fed approved the largest rate hike in almost 3 decades. Fox 40's Carmen Dickerson joins us live with what that increase potentially means for people here in Northern California. Hi, Karma.
Hi, Eric. Basically, it means that if you're looking to borrow money, it's going to cost you more. They expect it to decrease the buying power of some individuals, and things like mortgage rates, yes, could be affected. If you're debating a summer splurge versus paying off a credit card, financial advisors say treat yourself to less debt.
Credit cards, adjustable rate mortgages, and loans that are based on a variable rate should pay that down as soon as possible because those rates are going to go up.
Federal Reserve has announced a 0.75 percentage interest rate increase, the largest in nearly 30 years. They're hoping it solves a problem that's at a 40-year high: inflation.
We're going to see things become a little bit more expensive in the short term, but short-term pain is for long-term gain.
Or at least that's the goal. The Fed is betting higher interest rates will make consumers less likely to borrow and spend money. In other words, lowering demand. With demand back in line with supply, prices should theoretically come down as well. In the meantime, the average person may see some benefits.
If you are saving, you may see a benefit because you'll probably get more interest from your savings account. If you have a fixed mortgage that you got 2 years ago, you're probably in very good shape as long as you don't refinance.
It remains to be seen how much of an effect the Fed interest rate hike will have on mortgage rates in Sacramento's housing market. Recent, more modest interest rate increases have limited buyers' spending power, says Aaron Stump, president of the Sacramento Realtors Association. Still,
at least at this point, it hasn't seemed to demotivate any buyers. If anything, many buyers are motivated to get into a home while the rates are still pretty good.
Stump says the last 2 years of a fast-paced housing market that heavily favored sellers has created an imbalance. One she says a Fed hike could even out.
I think there's going to be a shift, but I think it's going to end up at an equitable place between buyers and sellers.
So the takeaway here is there's a lot of wait and see, and there's a lot of the Fed gambling on this measure actually having a positive effect on the economy and people's wallets. But in the short term, plan to, yes, be spending even more in some cases. And they definitely say if you can pay off that debt, that would be a good idea if you're talking about things like credit cards or variable rate mortgages. Reporting from Sacramento, I'm Carmen Dickerson, Fox 40 News.